Now we will see under the revaluation of non-current assets. We can see the second example. Example number 2 or exercise number 2. Here we says Pereira has a year end of 31st December each year. He has year end of 31 December each year. In this statement of financial position as at 31st December 2022, right? 31st December 31st December 22, right? He had his buildings shown the cost of land and building, right? Building cost, building cost shown at 3,600,000, 3,600,000. Asset asset 31st December 2022. Building shown at the cost of 3,600,000. Accumulated depreciation shown as 1,080,000. 1,080,000. Right? And accumulated depreciation 1 million. His depreciation policy is to charge 2% on straight line method. Depreciation policy straight line method. Straight line method. At 2%. Right? On 30th June 2023, the building is to be revalued at 3,070,000. 31st, no, 30th June, 30th June 2023, right? Revaluation, building, right? Building. Okay, how much? 3,072,000. 3,072,000. There is no charge in the remaining. There is no change, right? There is no change in the remaining estimated useful life of the building. Estimated useful life, full life, not given. We have to calculate the useful life. Revaluation amount is given, right? Estimated useful life of the building not given. They said as there is no change. Show relevant ledger accounts for the year ended 31st December 32. We have to show the accounts at end of the year. That means we will calculate revaluation gain, record the revaluation gain, and calculate extra depreciation again, and revaluation account as at end of the year. Before going to that, we have to calculate the useful life, right? Then the useful life is, before calculating the useful life, you have to calculate the depreciation amount. 2% in the sense straight line method, 2%. That means on 3,600,000. On 3,600,000, you are applying 2% in 72,000. That means you have to put it inside the bracket 72,000. 2% in the sense 72,000. 72,000. Okay. So useful life, you can calculate it. There is no there is no uh, scrap value is not given, so you have to say useful life, the scrap value is 0, so you don't need to bother, right? Useful life 3,600,000 divided by 72,000, 50 years. 3,600,000 divided by 72,000, 72,000. Then it comes to 50 years. 50 years. Right. We can calculate it separately, no? It will be confusing for you, right? So we will remove this one. Given these are the facts given, okay? These are the facts given for you, right? From that we have to calculate the balance, right? You will say these are the facts given. We will put it in the box, right? Then your workings will be separate. This is the facts given, right? What we have to calculate? Depreciation per annum. Depreciation per annum equal to 3 million, that is 3,600,000 into 2%. That means you will have 72,000. Okay. Then useful life, you will say 1,000,000, 3,600,000 divided by 72,000. That means 50 years. 50 years. Right? Now, again, depreciation made for. Depreciation made for. Accumulated depreciation made for. That means 1,080,000 divided by 72,000. Right? For that, we have to calculate it. Right? This all you, if you calculate and keep it at that time when you are need it, it is easy for you, right? 15 years. Okay, 15 years. Okay, that means for last 15 years we have made the depreciation for this particular assets. So years remaining useful life useful life 50 minus 15, 35 years. 35 years is the remaining lifetime. This is our workings, right? Workings. This is fact given. This is our working. Okay. Here very clearly we have calculated some needed ingredients. Right? This revaluation is carried out during the year of 2023. Okay. So for this amount is should be divided by 35 years. So straight line method is going to change or might increase the value. Right? Straight line method, what do you call that, percentage, there might be a change. Okay, there might be a change. There won't be any change. Amount will be a change in the amount. Okay, so here revaluation surplus. Yes, first revaluation gain. Question number 1, revaluation gain. That means net book value, that is revaluation gain, that is equal to fair value is 3,072,000 is the fair value. Okay, minus net book value. Net book value 3,600,000 minus 1,080,000. 1,080,000. Okay, this is the revaluation going to take place. Right. 3,072,000 minus 3,600,000 minus 1,080, 2,500 minus 3,072. Revaluation surplus of 552,000. 500, that is 552,000 is the revaluation surplus gain. Revaluation gain is 5,052,000. That is the revaluation gain. Okay, this is the revaluation gain. Right. I said December for this particular transaction. Relevant record the revaluation gain. Record the revaluation gain. Then you have to open the accounts. Building account, building, debit, credit, right? At 31st, we will say of first of 23rd, balance brought forward is 3,600,000. 3,600,000. Okay. Accumulated depreciation, debit, credit. Accumulated third depreciation on 1/1/23, balance brought forward 1,080,000, right? Then revaluation account, that is, I'll put it here, revaluation account. Account. You don't have any balance yet. Okay. The transaction started here, 3,600,000 brought forward that. Okay. This is okay. Okay. Then we say the five by 552,000 the revaluation take place. What is the revaluation? Right? Here we will say decrease by the value. Building is decreased. Okay. The amount is decreased by 552,000. By 552,000, the value of the building is decreased. Right? Then this is the revaluation loss. There is a revaluation loss taking place for the building. Here, if you say 552,000 revaluation, not gain, this is the loss. Revaluation gain. Okay. So here we have mentioned amount is increased, right? Here book value should be 372, 3,072. Then by how much it is decreased? See, from 3,600,000, it has decreased to 3,072,000. Right. So 528,000 it is going to decrease. The amount going to decrease. Right. So here we will say revaluation account. 528. 528,000. Right. This is building. This is revaluation account. Right. Then what is happening? We have to transfer the revaluation accumulated profit. Accumulated profit it transferred to the revaluation account. Right. Okay. 1,080,000. This is revaluation account. Here we will say accumulated depreciation is 1,080,000. 1,080,000. Right. Okay. The transaction had been completed. Now this is okay. This is okay. Here we will say 3 million and 3 million and 72,000, 3 million and 600,000. Here 3 million and 600,000. Right. Here brought forward balance. Balance brought forward on 1/1/24 is this. This is 31st 12/23. Right. 3 million, 3 million and 72,000. Okay, understood. Now we are going to calculate whether there is a profit or loss in this particular revaluation. Here you say, here it's a greater amount is 1,080,000. Here is 1,080,000. Right. So this is a revaluation surplus. That is 1,080, 1,080,000 minus 528,000. That is 552,000 revaluation profit, revaluation surplus. Carried down. Balance is 552,000. This is a revaluation reserve. Revaluation reserve. This is revaluation. This revaluation account will be shown under the equities because it is a credit balance. It is a profit. It is a gain. It is a gain. Revaluation gain. Okay. So we have completed the record the revaluation gain. We have completed. Now they want us to do the calculate the extra depreciation. What is the extra depreciation? Right. Now the value is 3,072,000. Value cost of building is 3,072,000. Useful life equal to 35 years. So depreciation charge for the year 3,072,000 divided by 35. Right. That means 3,072,000 divided by 35 years means the depreciation for the year will be 87,772. Right. Depreciation for the year, new depreciation, right? New. This is a revalued cost. Revalued amount. Rebuilding is useful life is remaining useful life depreciation for the year. Now you can understand very good. Right, this is the new depreciation charge for the year. Previous current depreciation, right? Current depreciation charge. We have to say the terms should be clear. This will be the current depreciation, current and future depreciation charge for the year. This is previous depreciation, less previous depreciation for the year. Yeah. That means This is 72,000 was the previous depreciation. Then 15,772 will be the extra depreciation. Extra this is the extra depreciation is 15,000. So you would have understood clearly. Now we are in the third part of the answer. This is second part. This is the third part. Right? This is the third part. Here you say revaluation of building. Right? Revalued amount is 3,072,000. Here 3,072,000 we have put here. Remaining useful life, we have calculated the remaining useful life here. Yeah, remaining useful life. Okay, this is the remaining useful life, right? Useful life. This is the remaining useful life. Here, this minus this, the remaining useful life. 50 minus 45. That means 50 minus 15. Right? That is the this one. Okay, so remaining useful life 35 years. So earlier 2% calculation is done in the 2%, but they are giving that there is a shift in the depreciation policy. So from the 2% we are going to give some new percentage, means we'll see divided by 3,072 into 2.86%. New percentage is 2.86. Right? New percentage is 2.856. Right? 2.856. Okay. So new depreciation charges 3,072,000 divided by 35 useful life. We have new remaining useful life is 35 years because the depreciation is 72,000. Then useful life would be 3,600,000 divided by 72, that is 50. Depreciation is made for 1,080,000, right? Depreciation balance made for 1,080,000 divided by 72,000, in the sense we will get the 15 years. For last 15 years you made the depreciation. The accumulated depreciation is carrying out on the 15 years depreciations. That's what we assume, that 15 years as lifespan has gone out of 50. Then 35 years is remaining. Then 35 years remaining years divided by 35. Then you will get the new depreciation charge for the year, that is 87,772. So previous depreciation 72,000. So extra depreciation will be 15,772. Understood? This is for extra calculation for the extra depreciation. Then next is revaluation account at the end of the year. Revaluation account is at the end of the year. This is the third one, fourth revaluation account. At the end of the year, this is the revaluation account. There is a revaluation reserve account, revaluation surplus account, 552,000. Right? That will be shown with the equities. Right? This is the way. Okay. If you want to write off the extra depreciation against this, right? If you want to um, write down the extra depreciation, then the entry will be given like this, right? I will write this there. It would have been difficult for you also to understand this revaluation of building or something like that. New revalued cost of valued cost of building is 3,072,000. 3,072,000. Right? Remaining useful life. Remaining useful life. How do you calculate the remaining useful life? The current cost of the building divided by remaining useful life. Remaining useful life is 35. Remaining useful life. That is equal to remaining useful life is 35. Right? Remaining useful life. You will wait 35 years. Right? This is remaining useful life is current useful, earlier useful life, right? Earlier useful life useful life useful life before revaluation, right? We had to say useful life before revaluation, right? Useful life before revaluation. Before revaluation, right? Before okay, before the revaluation, revaluation is 3,600,000. 3,600,000 divided by 72,000. Okay, 72,000 equal to 50 years. Right? is equal to 50, right? And useful life accu- uh, years the uh, of accumulated of accumulated depreciation done, that is 1,080,000 divided by 72,000 is equal to 15 years. It equal to 15 years. Then 35 would be the remaining useful life. 35 years. This is working, right? It's the working for this. 35,000. Okay. Then depreciation charge for the current year. Depreciation charge for the current year. is equal to 3,072,000 divided by 35 years. That is equal to 87,772. 87,772. Previous depreciation for the year 72,000. Extra depreciation. This. This is the extra depreciation, right? This is the extra depreciation. This is the current depreciation for you. Shall we charge the depreciation? Oh my god. Right? We can charge depreciation. Accumulated depreciation account. credit 87,000, 87,772, and depreciation account credit, debit depreciation account credit, debit depreciation account debit 87,772, right? This is accumulated depreciation, accumulated depreciation. This is depreciation for 30th 12 23, right? This is go to the profit and loss account 87,772. This is the carried down balance 87,772. First 24 brought forward this 87,772. Right. So we have done the depreciation also, new depreciation. New depreciation is 87,000, or if you are doing depreciation for earlier amount is, it would have been the 72,000, right? 72,000. So the difference between them is 15,000. So we have charged, instead of 72,000 we have charged 87,000. So the business is business's income is reduced by 15,772. So if the business want you to add this amount back, the difference to the revenue, you can add it by removing the 15,772 from this revaluation account debit and credit to the retained earnings. You have to credit to the retained earnings. You can debit and credit to the retained earnings and distribute, right? That is not needed for you at this level. So these are the basic explanation I have given. So this is the number 3, right? This is began. Okay, workings. This is number 3. You keep this as a number 3. So it will be easy for you. You can uh, understand very easily, right? Again, I will explain you the cost of building. I am not going to read a whole question. The summary of this question is, building shows that 31st of December 2022 values are given, right? Building 3,600,000, accumulated depreciation 1,080,000, and depreciation percentage is 2%. Straight line method, right? They said 30th 6 2023 revalued at 3,072,000. They have revalued. So we have put the brought forward balances. We have recorded as building and accumulated profit, right? This is also okay. This is okay. 3 million, 1 million. So depreciation is straight line method 2%. So calculate the what is the amount of 2%. So 2% calculated on 3,600,000. Here depreciation per annum is 3,600,000 into 2%, that is 72,000. 72,000. This is the earlier depreciation. So useful life, you divide this 3,600,000 divided by 72,000. So you will arrive at the useful lifetime of this asset building. So depreciation per annum is 3,600,000. The cost is and at the percentage, if you apply the percentage, that is 72,000. So useful life 3,600,000 divided by 72,000, which is the depreciation. Okay, this is the 72,000, which is the depreciation. So if you divide by 3,600,000 divided by 72,000, the 50 years useful life is 60 years. So you have got the information of how many years this particular asset is depreciation. You have the depreciation percentage, then it is easy to calculate the depreciation, the useful life. That's how we have calculate, right? Other one is accumulated depreciation balance. They have given the accumulated depreciation balance, right? So you have put here accumulated depreciation 1,080,000. Now you have to calculate the number of years to how much for number of, for how many years, you have calculated this accumulated depreciation. So 1,080,000 they have given, right? You know the factor of how much the depreciation made for each year, because it is on straight line method. There won't be any change if it is a straight line method. So 72,000, you know, then divide by 72,000, then you will get the 15 years. For 15 years you have done the depreciation. That's what this accumulated depreciation consists, 15 years depreciation. So 15 years you have done the depreciation, so you have used it for 15 years. So useful life is 50 years, then you have used for 15 years. This is 50, this is 15 years. Then remaining useful life 50 minus 15, 35 years. Remaining useful life 35 years when you are calculating this revaluation, when you are making the revaluation assessment, right? That's what we have mentioned here, 35 years. Understood? Remaining useful life is 35 years. Revalued cost is building is 3,072,000. Then depreciation charge for the current year is 3,072,000 divided by 35 years. 35 years. This is the 35 years how we arrive. This is the 35 years how we arrive. Right? Previous depreciation for the year is 72,000. Here, previous year 3,600,000 into 2%, that is 72,000. So what is the extra depreciation we are making? Current new depreciation after evaluation is depreciation charge for the year, for the year, rather than saying for the year, in the sense depreciation charge after the revaluation, right? After revaluation. After the revaluation is 87,772. Rather than saying previous, depreciation before revaluation. Depreciation before revaluation. Before revaluation. And this is a good term where you can understand. Depreciation before revaluation is 72,000. So easy to understand for you. Depreciation charge after revaluation. depreciation after charge after revaluation. Otherwise we can say depreciation so we say after revaluation, depreciation after revaluation, right? Understood? This is depreciation after revaluation. This is depreciation before revaluation. This. So extra depreciation is this. Okay, understood? So I hope you would have understood and do more and more exercises. And if you have any, if you come across any doubts, you can ask me. Okay. So with this one, I am concluding my lectures. So we will meet you in next lesson. Okay. Thank you.